Welcome back to the deep dive. It is Wednesday, January 21st, 2026, and today we're really doing a postmortem on the last 12 months. Because if you've been tracking the headlines, even, casually, the business landscape just shifted under our feet in 2025.
It really did.
It wasn't just fast, it felt like a complete structural realignment.
Well, we spent the last few years waiting for this new normal to finally settle in, and I think 2025 was the year it arrived. But it really didn't look like what anyone predicted back in 2023.
Not at all. We're looking specifically at the huge resurgence of global M&A, that's mergers and acquisitions. We have a whole stack of reports here. We've got Bain, McKinsey, some really fascinating market analysis out of the Nordic region.
And the headline number is just staggering.
It's hard to ignore. Global deal value surged nearly 40% in 2025, hitting, approximately $4.9 trillion?
$4.9 trillion. That makes it the second highest year on record, just, right behind those outlier years with the pandemic stimulus.
Wow.
But I think if you only focus on that number, the $4.9 trillion, you're kind of missing the forest for the trees. The volume is impressive, sure, but the nature of these deals has just fundamentally changed.
Okay, how so?
Well, we aren't seeing companies just buying competitors to grab market share anymore. This whole thing was fueled almost specifically by artificial intelligence. And I don't just mean buying AI startups.
Right.
I mean using AI as the primary engine to actually execute the deals themselves.
That's the core distinction we have to unpack today. The narrative has shifted from, who is buying AI to how is AI buying companies. But before we dive into the mechanics of the tech, let's just look at the market psychology. We went from that down cycle of 2022, 2023.
Where interest rates just froze everything.
Exactly.
Yeah.
Frozen, and then the sudden explosion. But reading through the Bain report, they use this very specific phrase to describe the behavior. They call it selective dynamism.
Selective dynamism. It's a great term. It basically means that the old spray and pray approach from the venture capital boom is it's dead. In 2025, deal makers became incredibly surgical.
So less gambling, more calculated sniper shots.
Precisely. If you look at the breakdown, the deal volume, so the raw number of transactions, is still recovering pretty slowly. But the deal value is sky high.
Okay, so what does that tell us?
It tells us that when companies decide to move, they are swinging for the fences. Mega deals, so transactions over, say, $2 billion, were up 20% compared to 2024. And inside the tech sector, which jumped 77% in total activity.
77%.
Almost half of those big deals involved AI-native companies.
That tracks. I mean, boards are terrified of being left behind by this AI wave, so they aren't looking for small, incremental gains. They're looking for these huge transformative assets.
I have to be.
But what really stood out to me in the research stack is where a lot of this action is concentrated. We usually talk about Silicon Valley, maybe London, but the data is pointing these giant neon arrows at Northern Europe. The Nordics, Sweden, Denmark, Finland, Norway, they're punching incredibly high right now.
Oh, they're punching way above their weight class. The Nordic region has, in effect, become a laboratory for this whole selective dynamism idea.
Yeah.
In 2024 alone, while, the rest of Europe was still waking up,
Right.
the Nordics saw 3,772 announced deals. That number actually surpassed their pre-slowdown levels.
That's remarkable, especially given the population size. I mean, we're talking about roughly 27 million people across 4 or 5 countries, and they're generating deal flow that's comparable to major G7 economies.
But you have to consider the pedigree. This is the region that earned the nickname the Unicorn Factory.
Spotify, Skype, Klarna.
Exactly.
Yeah.
Super so. They have a track record of building digital infrastructure that scales globally. And now, technology accounts for, about 24% of all the deals in that region? Investors see the Nordics as a safe harbor. You get the economic stability and transparency of Northern Europe, but it's combined with this really aggressive innovation culture.
It's a very attractive mix when the global markets feel so volatile. Okay, so we have a $4.9 trillion market. It's fueled by these high-value tech deals, and the Nordics are acting as a key engine. But I really want to spend some time on the how. You mentioned that AI is moving from being the product on the shelf to the engine in the back room.
Right.
How is generative AI actually changing the day-to-day grind of M&A? Because traditionally, this is such a human-heavy industry. Investment bankers, lawyers, just endless spreadsheets.
It is, or I should say it was. The process is being rewired across 3 main phases: sourcing, due diligence, and integration. So let's look at sourcing first. Historically, finding a target company was all about your personal network or, filtering databases by these clunky industry codes. Yeah. It was messy, and it was biased.
So you basically bought who you knew or who was shopping themselves around.
Exactly.
Yeah.
But now, firms are using large language models to scan the entire market semantically. The McKinsey report highlights this case, where a firm used an AI tool to search 40 million companies.
40 million.
But they didn't just search for a software company. They searched for specific, unstructured criteria, things like companies with adjacent technology stacks to ours, or find hidden gems with high R&D output but low marketing visibility.
So it's understanding the concept of the target, not just the keywords.
You've got it. The AI narrowed those 40 million companies down to 15 priority targets in a matter of days. That level of market mapping used to take analyst teams weeks, and even then, they'd still miss the non-obvious choices.
Yeah.
It just removes the availability bias.
So you're not limited to the companies your banker had lunch with last week.
Exactly right.
That brings us to phase 2 then. Due diligence. This is usually the bottleneck, right? I've spoken to folks in M&A who describe this as the burnout phase, just reading thousands and thousands of contracts, looking for liabilities, checking IP.
It's a nightmare.
It sounds like the perfect job for a machine, but is it really safe to trust an AI with that?
That's the big question. And what we're calling AI due diligence. Well, the adoption rate suggests the industry has decided the risk is worth it. You can feed an entire virtual data room, so thousands of PDFs, financial records, all of it, into an AI.
And it doesn't just read them.
It doesn't just read them. It
Yeah.
analyzes them for risk. It can flag some weird liability clause on page 400 of a vendor contract in, seconds.
But I have to imagine there's a human in the loop element here. I mean, I can't imagine a general counsel signing off on $1 billion deal just because a chatbot gave a thumbs up.
Oh, absolutely not. The AI isn't making the decision. It's acting as the ultimate triage nurse. It just highlights the anomalies so the senior lawyers can focus purely on the high-risk items instead of wading through all the standard boilerplate.
Right, so it cuts out the noise.
And the feedback from early adopters, about 78% of them, is that it significantly reduces manual effort. It solves that fatigue problem. A junior analyst might miss a critical detail after 14 hours of reading. The AI won't.
Okay, so then we get to phase 3, integration. This is where the bodies are buried, right? Most deals fail not because the price was wrong, but because the two companies just couldn't actually merge their cultures, their IT systems.
This is where we're seeing the most futuristic applications. It's the rise of the Gen AI coach, or agent. Imagine an integration lead just asking the system, hey, we need to merge our customer support protocols with theirs. Draft a 90-day plan based on our historical best practices.
So the AI just does it.
It ingests the playbooks from both companies, and it generates a strategic roadmap.
It's essentially automating the role of a change management consultant.
To a very large degree, yes. And Bain predicts that within 5 years, virtually every step of this M&A process will be AI-enabled. It's moving from a tool you use for specific tasks to, well, the underlying operating system of the deal itself.
This brings me back to the Nordics. We've established that the region is hot, but I want to really understand why they're so well-positioned for this specific AI-driven boom. I mean, you can't run these massive models, these high-speed agents, on old copper wire.
No, you absolutely can't.
Yeah.
This is all about what we call AI readiness. You need 3 things. Computing power, you need data, and you need the pipes to move it all. The Nordic infrastructure is arguably the best in the world for this.
Okay.
Sweden is number 2 in the EU for high-speed broadband. Over 85% of households there have gigabit-ready connections. Denmark leads Europe with about 83% 5G availability.
And there was a stat about Finland that just jumped out at me from the notes. The data consumption per person.
That's a staggering number.
Yeah.
Finns consume an average of 41 gigabytes of mobile data per person per month,
41 gigs.
which is 4 times the OECD average.
That seems unbelievably high compared to the US or UK markets. Is that just because they're streaming a lot of video?
Well, it's partly cultural, but it's mostly structural. They have affordable, truly unlimited data plans, so people live their entire digital lives on the network. But for AI, that consumer data is just the surface. The real asset is the physical internet.
Right.
We're talking about projects like the Sea Lion 1 cable, which links Helsinki to Germany, and the Far North Fiber.
The Far North Fiber project, that's the one connecting Europe to Asia via the Arctic, correct?
Correct. It's a trans-Arctic cable, planned for completion around 2027. It links Europe straight to Japan. Geographically, that's the shortest path you could take.
So you shave off latency.
By going through the Arctic, you shave milliseconds off the latency between, say, London and Tokyo.
And for most of us, milliseconds don't matter. But in high-frequency trading, or for real-time AI agents negotiating across continents, those milliseconds are worth billions.
Exactly. Latency is the new currency. The Nordics built the digital highways, the AI autobahns, if you will, and now that the world is switching to these heavy AI workloads, that infrastructure is paying massive dividends.
But infrastructure is only half the battle. The other half is the rules of the road. And we can't talk about Europe without talking about regulation. The EU has a reputation for being, let's say, thorough with its rulemaking.
That's a diplomatic way to put it.
And we had the AI Act approved back in March 2024.
The world's first comprehensive AI law, a landmark moment. It categorized AI into tiers. Unacceptable risk was banned, high risk got strict compliance rules, limited risk was largely left alone.
But looking at the updates from late 2025, the tone seems to have shifted a bit. The European Commission proposed this digital omnibus in November. Reading between the lines, this feels like a reaction, maybe a fear that Europe was regulating itself out of the race.
That is absolutely the dominant interpretation. The digital omnibus proposed delaying the enforcement of the high-risk rules all the way until December 2027. And, more controversially, it proposed easing some GDPR rules to let companies train AI models on broader datasets.
Why?
Because the Commission realized that while they were busy writing rules, the US and China were busy building models. There was a genuine panic about an innovation gap.
So the narrative from the Commission is simplification, but naturally, this triggered a massive backlash.
A huge backlash. Digital rights groups like EDR came out swinging. They called it a massive rollback of privacy rights. Their argument is, look, if you let companies scrape personal data for training without strict consent, you can't put that genie back in the bottle.
You're trading fundamental rights for short-term economic competitiveness.
That's the tension. Innovation speed versus safety. It's the classic fight.
But this is where the Nordics seem to be trying to carve out a third path. They aren't just following the EU blindly, but they're not going full Wild West either.
That's right. In October 2025, they launched the New Nordics AI Center in Helsinki. Yeah. And their thesis is fascinating. They believe that responsible AI is a product feature, not a compliance burden.
High tech, high trust.
Exactly. In a world that is flooding with deepfakes, algorithmic bias, hallucinations, being the trustworthy option becomes a competitive moat. If you're a bank or a healthcare provider, are you going to buy the AI model that plays fast and loose with data? Or the one built on the Nordic framework of transparency and ethics?
They're betting that ethics sells.
It's a very smart bet.
It's smart positioning. It turns the regulation from a hurdle into a brand attribute. But I want to ground this. We've talked high-level strategy, infrastructure, laws. Let's look at some of the actual deals that happened. The source material highlights a few that really illustrate these trends in action.
One that perfectly shows that infrastructure meets AI trend is Nordic Semiconductor buying Newton.ai. That was in June 2025.
And this is that hardware-software convergence?
It is. Nordic Semi is a classic chip maker. Newton.ai specializes in something called Tiny ML. These are machine learning models so efficient they're under 5 kilobytes in size.
5 kilobytes? That's smaller than an empty Word document. Why? Why does that matter?
Because it lets you run AI directly on a microchip, inside a sensor, a wearable, a medical device, without ever needing to send data to the cloud.
Ah, so it saves battery, reduces latency.
And it protects privacy.
Yeah.
The deal just shows that hardware companies realize they can't just sell silicon anymore. They have to own the intelligence that sits on top of the chip.
Then we have a deal that speaks to the desperation for talent. Accenture buying Halfspace in March 2025. Halfspace was a boutique Danish firm.
This was a pure acqui-hire. Accenture has clients screaming for Gen AI implementation, but there's this massive global shortage of engineers who actually know how to build this stuff reliably.
So they just bought the team.
Accenture didn't buy Halfspace for their IP. They bought them to get their 80 experts in the building immediately. It's just faster to buy a company than it is to recruit 80 senior engineers in this market.
It really confirms that talent is still the scarcest resource, even in the age of automation. I also want to touch on the Databricks deal from 2023 when they bought Mosaic ML for $1.3 billion. That feels like the precursor to what we're seeing now.
It was the signal flare. Mosaic ML allowed companies to build their own secure models instead of just renting access to OpenAI or Google. It signaled this trend of democratizing AI.
Right.
Enterprises realized we can't just rent intelligence, we need to own it. And that deal really set the stage for the valuation spikes we saw in 2025.
And finally, Thomson Reuters buying Case Text. I mean, this is the one that really hits home for the professional services industry.
It's the reinvention story. Thomson Reuters is an information giant, but a very traditional one. Casetext was a startup offering CoCounsel, which is a GPT-4-powered legal assistant. By buying them for $650 million, Thomson Reuters wasn't just buying a tool, they were buying their future survival.
They saw the writing on the wall.
They realized that if they didn't own the AI that analyzes the law, someone else would, and they would be replaced.
It really underscores that no industry is exempt. It doesn't matter if you're making chips, consulting, or selling legal precedents. M&A is the mechanism you're using to pivot.
That's the key takeaway. AI isn't a vertical industry anymore. It's a horizontal layer that sits across everything. The M&A boom we are seeing is just the sound of the entire global economy trying to install that layer at the exact same time.
So bringing it all together for our listener, we've gone from $4.9 trillion in deal value to Arctic cables to these tiny little microchips. What's the synthesis here?
The synthesis is that we have finally moved past the hype cycle and we are deep into the integration cycle. 2025 proved that companies are willing to spend trillions to fundamentally rewire how they operate. And the Nordics are winning because they have both the physical and the ethical infrastructure to support that rewire.
And looking ahead to the rest of 2026, what should we be watching?
Keep your eyes on autonomous AI agents. We're going to see software that can plan and execute complex workflows all on its own. And of course, watch the regulatory space. If that digital omnibus passes, we might see a second wave of European innovation trying to catch up to the US.
I want to leave us with one final thought, a bit of a provocation based on what we discussed with that Gen AI coach.
Go for it.
Okay, so we've established that AI can scan the entire market for targets. It can perform due diligence to find risks. It can even draft the integration plan to merge the two companies.
We did, yes.
So the logical endpoint here seems to be, how long until an AI agent analyzes its own parent company, realizes it's undervalued, finds a suitable buyer, and then negotiates its own acquisition?
That is a terrifyingly plausible scenario. It brings a whole new meaning to creating shareholder value if the algorithm decides the best path forward is to just sell the company.
It certainly does. But for now, for those of you listening, I think the key is to stop viewing AI as some futuristic concept. It's your new colleague in the deal room.
And it's probably reading the contract much faster than you are.
And likely spotting the errors you missed. Thanks for joining us on this deep dive.
My pleasure.
We'll catch you on the next one.